If time is money, why do the poor opt to wait for buses while the wealthy drive or take taxis? In the realm of time, the renowned 19th century British biologist Thomas Huxley once remarked, "Time is the least discriminatory, for it gives everyone 24 hours, yet it is the most discriminatory, for it gives no one the same 24 hours." The initial part of his statement is straightforward, suggesting that everyone has the same amount of time daily. However, the latter part can be interpreted to mean that each individual spends varying amounts of time on essential activities, such as sleeping and eating, and there is a difference in how efficiently people use their time. Therefore, within the same day, the value manifested by time differs greatly among individuals. Most people probably have never calculated the value of an hour, but Benjamin Franklin, one of America's founding fathers, did. One day, as he was preparing a manuscript, a young customer entered his bookstore, picked up a book, and asked the clerk for the price. The clerk replied, $1. The customer inquired, "Could it be cheaper?" The clerk insisted, "The price of the book is $1. The customer said, "I would like to see Mr. Franklin, the owner of the bookstore." Franklin then came out from the back room. The customer asked, "Mr. Franklin, how much for this book?" Franklin replied, $1.15. Surprised, the customer said, "Just now, your clerk said it was only $1. Franklin explained, "Had you bought it from him then, I could have sold it to you for $1, but you see, I was busy and you called me out." The customer persisted, "Mr. Franklin, what is the lowest you can sell it for?" Franklin answered, $1.50. The longer we discuss, the more of my time you take, and the more expensive the price I will have to charge you. Eventually, the customer paid $1.50. Convinced. Franklin's valuation of time closely aligns with the economic concept of opportunity cost. Simply put, if the choice you make at a moment is considered the best by you, the value of the second best choice you could have made is your opportunity cost. Given the fleeting nature of time, Mr. Franklin had ample reason to charge for the value of his time, the opportunity cost, from customers interrupting his work. Similarly, it's understandable why wealthy individuals prefer to drive or take taxis to save time, as the opportunity cost of taking slow public transport is too high for them. In essence, they are buying time with money, which is negligible compared to their wealth. Continuing the narrative, let's delve into another illustrative example that further encapsulates the time is money concept, using the story of a modern-day entrepreneur, Maria. Maria, a tech startup founder, often juggled numerous tasks and responsibilities daily. One day, she found herself in need of a new laptop, as her current one was malfunctioning and hindering her productivity. She faced two choices: order the laptop online and wait for the delivery, which could take up to 3 days, or drive to the nearest electronics store, which was an hour away, to purchase and obtain the laptop immediately. Calculating the opportunity cost, Maria considered her hourly earning potential. As a startup founder, her work on a crucial new product feature was projected to significantly increase her company's revenue. Every hour she spent not working on this feature translated to a substantial potential loss in future earnings. Choosing to drive to the store, despite the 2 hours it would take to travel back and forth, plus the time to select and purchase the laptop, represented an immediate time investment. However, Maria understood that by acquiring the laptop the same day, she could resume her high-value work sooner, mitigating the potential revenue loss that waiting for a delivery would incur. This decision exemplifies the time is money principle through the lens of opportunity cost in a decision-making process, For Maria, the direct cost of her time spent driving was outweighed by the potential loss of revenue from delayed work. Thus, investing a few hours to get the laptop immediately was economically more rational than waiting, even though the latter option required less physical effort and time up front. Maria's story illustrates a key aspect of the time is money concept. When the potential earnings or value of one's time significantly surpass the immediate costs of saving that time, it becomes economically advantageous to choose the option that frees up more time for high-value activities, even if it involves an upfront investment of time or money. This decision-making process highlights the importance of evaluating both the immediate and longer-term economic impacts of how one chooses to allocate their time, especially for individuals or businesses where the value of productive time is particularly high. In essence, the time is money principle is not merely about the literal exchange of time for money, but rather about making strategic decisions that optimize the economic outcomes of how time is spent. Whether it's Franklin's incremental charge for his time, the wealthy opting for faster transportation, or Maria's trip to purchase a laptop immediately, each scenario underscores the significance of valuing time as a finite and valuable resource. These examples collectively emphasize the universal applicability of the time is money principle across different contexts and economic decisions. Understanding and applying this principle can lead to more efficient use of one's time, ultimately resulting in better financial and personal outcomes.